Good morning, everyone, and welcome to the Pro Manchester Annual Corporate Finance Lunch. It's great to see that many of you have already joined us. I think a couple more are still coming in. So whilst we're just waiting for the remaining few to join us, can I just do a little bit of housekeeping? So during today's session, unless you are on one of the panels or one of the speakers, can I please ask that you keep your microphones off, please, just to avoid any sound interference. Also, just to let you know, we will be recording today's session so that those who can't attend today, we can pop it onto our YouTube channel and people can watch back a little bit later on. So nobody gets to miss out, fortunately, which is great. We do want you to participate as much as possible, but to make that easier, can you post all of your questions in the chat box at the bottom of your screens here as we're going through? That would be fantastic. Now, without further ado, I would first like to introduce a welcome video from our sponsors for today's lunch, which is the International Stock Exchange, TISE.
Good afternoon, ladies and gentlemen, and welcome to the Pro Manchester Corporate Finance Lunch for 2021. On behalf of the International Stock Exchange, TISE, I am delighted that we are able to support and sponsor this event once again. As we remain in the grips of the COVID-19 pandemic, 2021 looks likely to be another year that will remain etched on our memories. The world continues to fight for abolition of the pandemic, and as individual businesses, we each work through the effects of its ongoing and longer-term ramifications. It has certainly been a profound start to a new decade thus far, and the impact of COVID-19 has created nothing short of a massive challenge for businesses across the North West. For many, the challenge has been too great and led businesses to being forced to permanently close their doors, whilst for others, government support schemes have provided some welcome assistance that boosted cash flow requirements and provided temporary relief. That support continues for some, in a hope that business may resume in the medium term, whereas other businesses have acted rapidly to adapt their offering and sought new pathways for revenue generation, in some cases providing much needed services to protect and support local communities. For those seeking access to new investors through use of the capital markets, there has been a flurry of secondary equity issuance and some initial equity offerings through the large stock exchanges over the past 12 months, albeit that activity in the private markets continues to remain vibrant and dominant to some degree, and has potential for another busy year ahead with cash balances waiting to be deployed. Access to capital for many UK SMEs is likely to remain a challenge, and one which could create real stagnation to an already vulnerable UK economy. We will continue to advocate the consideration of early listing as a means to access capital markets and to support both scaling businesses in striving towards their aspirations and also for purposes of gradual capital exit for business founders. Business continuity plans were certainly tested across our industry of finance and professional services in 2020. For TISE, mid-March of 2020 saw a swift adaptation to working from home across our entire organisation and a necessity to keep the exchange fully operational. Our market surveillance team worked tirelessly to maintain market integrity, whilst adapting to the new challenges that were presented to our issuers, not least around the physical execution and submission of documents during the lockdown, as well as delays around both the production of financial statements and the completion of issuer audits. New listing applications did not abate in their volume during 2020, and by the year end, we had listed a further 831 securities to bring our total number of listed securities to 3,162. This is the second highest annual total of new listings since the inception of our exchange, eclipsed only by a bumper 2018 and represents a 27% increase on 2019. The early part of 2020 saw new listings related to private equity, real estate transactions, many of which were related to deals struck prior to the second quarter of 2020 and were in the process of completion through the initial part of the first lockdown. Hence, there was something of a time delay. Yet despite the backdrop, new listing applications continued to flow in not dissimilar volume and became increasingly related to corporate refinancing, whether opportunistic or essential, as well as greater proportions of securitisations and high-yield bonds as the year progressed. The latter included securities issued by companies such as Altice and Aircom, luxury Aston Martin, Legoland owners Merlin Entertainments, transport operator Stena and Netflix. Ties listings were also part of the structuring for 3 significant transactions in the third quarter of the year, the largest being the Liberty Global and Telefonica financing vehicle for the merger of Virgin Media and O2, the UK's largest pub chain, Stonegate Pubs, and debut first issuer, First Quantum Minerals. Listed debt securities on Ties also included a growing number of securitisations, with prominent deals including major UK banks, Barclays, HSBC, Lloyds and NatWest, as well as other global financial institutions. So what have we seen so far this year? Whilst new listings for January will be largely related to deals and transactions stuck in the latter part of last year, we note continuing refinancing activity. This is not surprising and a trend that is expected to continue throughout the year and beyond, given the wider backdrop. Private equity investment shows a degree of uptick, as anticipated, and suggests an increase in commitment of cash to market, and a possible turn of attention from last year's immediate focus upon existing portfolio companies. With continued low interest rates and availability of cash to deploy, we anticipate that there will be a fairly active buy-side activity as the year progresses, undoubtedly in the form of both opportunistic or rescue deals, as well as longer-term strategic acquisitions and resulting in new debt listings. As we continue to witness a trend of corporate refinancing, national organisations have also turned their attention to refinancing, as the impact of COVID-19 is expected to cause massive economic ramifications for the years to come. In certain cases, supranational debt has been issued through public markets as a means for accessing additional funds at reasonable cost and whilst often providing a means of creating greater public engagement and ownership. The UK also intends to issue its first green gilts in 2021, a move that is timely and follows the governments of Germany and Sweden having already issued sovereign green bonds. In real estate, Ties has also continued to grow its market share in the UK real estate investment trusts, REITs. 8 UK REITs were newly admitted to the exchange during 2020, with investors from various international jurisdictions, comprising sovereign wealth funds, pension funds, major global financial institutions, and specialist property investment groups. This took the total number of UK REITs listed on the exchange to 29 at the end of December, which represents more than 30% of the UK REIT market. With continued interest in REITs as a vehicle to access property exposure in a potentially more liquid and efficient form, we expect further interest throughout the year and have already seen new listings with underlying property assets, thus reflecting specific areas of interest and activity in the property market. Ties will continue to play its role in our local communities and the wider capital markets community through 2021 by supporting enterprise and endeavours for business to build back stronger after the ramifications of COVID-19. Thank you for listening, and I hope that you enjoy the remainder of today's event.
Great. A huge thank you to the International Stock Exchange for sponsoring today's event and making all of this possible. So a huge thank you to them. Now I'm going to hand over to Jane Turner, who is the research manager at Experian, who has helped us pull together the corporate finance report. We did send it round to you in your delegate packs. It is also on the website, but I'm going to pop it in the chat there as well, just in case anyone has missed it. But over to you, Jane, to talk us through the report.
Thanks, Sam. Hi, good afternoon, everyone. Firstly, I'd like to say thank you to Pro Manchester for inviting me along to introduce the 2020 Annual Corporate Finance Review, which I hope you've all seen. The review looks at current trends in the market, which are the most active sectors and deal activity in Manchester and the North West, as well as the professionals behind the deals. Our data shows the year got off to a good start. In fact, the first quarter recorded 220 deals with just over £2 billion in value, making it one of the most productive quarters for some time. Then, as the impact of COVID and the first lockdown started to take a hold, we saw those volumes fall sharply to just 99 deals in quarter two, as the uncertainty of the direction of the economy spread and deal makers were faced with the logistical and physical challenges of competing transactions in the COVID world. The introduction of travel restrictions and the lack of face-to-face meetings has made doing deals more difficult, and those that have completed have taken longer to close. As the disruption caused by the pandemic continues to spread, many deals were put on hold, and companies instead focused on preserving their cash balances to enable them to keep trading. However, it's not all doom and gloom. Resilience in the market was clear to see as we moved into the second half of the year. Volumes recovered and we saw a welcome upwards trend in the number of deals being done. Quarter three saw 171 deals done, and in the final quarter we recorded 205. Values rose significantly, so whilst year on year the 695 deals recorded for the region were around 20% fewer than in 2019, the £15 billion collective value was actually double that recorded in the last year, with a flurry of multi-billion pound deals announced in Q4 contributing to nearly 40% of that total value. Whilst activity declines in most sectors, M&A in the TMT sector has been particularly brisk, which is no surprise given that work, education and leisure activities have moved largely online. There was the IPO of the Hook Group in August and its subsequent trio of acquisitions, and the recent offer by Funds and Penta Capital for TalkTalk. The professional services sector saw the highest volume of deals, and the wholesale and retail and manufacturing sectors also continued to perform well. In the retail space, we saw a number of high-profile deals done by Boohoo, which brought the outstanding shares in Pretty Little Thing and the online businesses of Oasis and Warehouse. And in fact, the company has continued its buying spree into this year, snapping up Debenhams, Dorothy Perkins, Wallace and Burton. JD Sports continued its international expansion in the US, with the acquisition of the Shoe Palace in California. And other sectors, including construction and financial services, have seen values rise. The trend expected to continue through into 2021 as the markets bounce back. We also saw a shift in the type of deals being done. Although acquisitions were still the most common deal type, we saw a marked increase in fundraisings, both through the capital markets and private equity routes. Auto Trader, Redex Pharma, Boohoo, On the Beach, Assura Group, Blue Prism, and many others. These are just a few of the region's PLCs that turned to the capital markets in the year, with companies such as Rhino Products, F2G, Genencode, Push Doctor, and Economica returning to private equity. We recorded more refinancings for 2020 than in the previous 3 years combined, dominated by companies in the manufacturing, retail, support service and hospitality sectors. The volumes of refinancing in the Northwest, the Midlands and Yorkshire were typically much higher than in other parts of the country, as companies boosted cash reserves due to the detrimental impact of COVID on sales. Private equity continued to play an important role, accounting for an involvement in just over 22% of all transactions. Examples include Calisen PLC returning to private ownership less than a year after its IPO, as it agreed to be acquired by a consortium of private equity funds for 1.4 billion. ECI realised its investment in pet food manufacturer MPM Products in a deal worth 165 million. Palatine acquired a majority stake in NRG Fleet Hire, and LDC invested £36 million in Rhino Products, one of 4 deals completed by its Manchester office in November. Deals that were funded either wholly or partially with bank lending stood at just over 7%, with Northwest companies securing funding from traditional lenders, including HSBC, Barclays, RBS NatWest Group and Santander, as well as specialist lenders Shawbrook and Oak North. The bulk of the Northwest deals fell into the small cap and mid-market brackets, including those where no value was disclosed. There are too many to call out each one individually, but we've included the highlights from each quarter in the deal tables towards the end of the report. Northwest companies continued to acquire overseas assets, with many turning to the US, including the Hook Group, which acquired skincare brands Dermstore and Perricone to accelerate the growth of its beauty business in the country. Euro Garages expanded its reach in the US with the acquisition of Schroeder Oil. DWF welcomed Chicago-based Mindcrest to the group, and Fisher-Wack added Skysys, its first acquisition with new investor Bridgepoint. The Northwest proved to be fertile ground for inbound investment too, with deals including the sale by North Edge Capital of Cubic Motion to Epic Games in North Carolina, and Uber's acquisition of Cheadle-based AutoCab. Where the detailed office location was disclosed, our data shows that Manchester-based advisors worked on a total of 495 deals in 2020, worth 2.6 billion, which despite the market conditions is actually close to 15% more than in 2019. While most of these deals have been local, we have seen a number of deals outside of the Northwest where a Manchester-based team has advised, including Pinsent Masons advising Aberdeen-based John Wood Group on the sale of its industrial services business, Addleshaw Goddard and Zeus Capital advising Solihull-based Purple Bricks on the sale of its Canadian operations, and Hewitt's advising Cardiff-based companies Ironveld and Casera Global on their respective placing and acquisitions. According to our data, Gately was 2020's most active legal advisor in the region, followed by Hill Dickinson and Mills & Reeve. Gately advised on 46 deals, including 2 for Inspired Energy, whilst Hill Dickinson's work included advising LDC on its Rhino Products investment, together with DWF and Grant Thornton, and Mills & Reeve supported ADC Biotechnology on multiple fundraisings throughout the year. RSM recorded 26 deals, including Comhoist's £5 million investment from key capital partners, on which it works alongside Ward Hadaway and Davis Blank Furnace. KBS Corporate advised on 22 deals, including the acquisition by of Quantuma by its parent company K3 Capital Group, in which BDO advised on the buy side. Dow Schofield Watts worked on 18 deals, including 8 acquisitions in the year for RSK Group. Where deal teams were disclosed, Simon Warwick, Slater Healis, and Daniel Rothbone and Chris Moss, both Milton Reed, all worked on 12 deals apiece, making them the most active legal advisors, according to the data we hold. On the financial side, Tony Meakin from Dow Schofield was the most active, having advised on 8 deals, with Andrew Feek from Moore and Smalley on 5 deals. And then we have Ben Bradley at Hearst, Nick Wyatt RFM, and Nick Hume Benchmark, all on 4 deals each. There are further deals involving Manchester-based advisors detailed in the report, as again, there are far too many to call out individually. As the economy continues to recover, we would expect to see M&A activity to continue to rebound, with targets likely to emerge from a pool of sellers, including companies disposing of non-core assets as a result of reassessing strategies, businesses that have fallen into distress as the result of the pandemic, and cash-rich corporates ready to take advantage of any opportunities emerging, especially as government support comes to an end. Corporate finance will undoubtedly play a strategic role in the recovery of the markets, not just in the UK, but globally. Companies will be looking out for good value deals, especially in those sectors where pre-COVID valuations were beginning to look inflated. We may see deferred consideration and earn-out mechanisms become increasingly more prevalent, so that both future earnings and valuation risk is shared by the buyer and seller. There may be an upturn in distressed or accelerated M&A as companies continue to struggle to adapt to changes in the economic and social landscape. Businesses that may not have been actively pursuing an acquisition may take advantage of a depressed market and snap up good value assets at a lower price. It's difficult to say with any certainty whether the present COVID-19 pandemic will have any lasting effects on the approach parties adopt in the future of M&A transactions. However, the experience of previous economic crises, however caused, would indicate that after the initial shockwaves have died down and businesses are able to assess their impact, M&A transactions, whether opportunistic or strategic, will slowly creep back onto the corporate agenda. All of the data contained in the report is taken from Experience Market IQ platform. I'd just like to thank all of our contributors for sharing their deals with us throughout the year. It really is appreciated. If anybody has any more questions or would like to know more, please do get in touch, and I hope you will enjoy reading the report. Thank you for listening today, and I'm going to hand across to Anthony for the next part of the agenda.
Okay, great. Thank you very much, Jane. I must admit that I've read the report, and there's some really interesting statistics in there and some really positive findings, I think, given all the circumstances. And I think it shows the importance of the finance community and the role it can play with businesses, either whether or not they're in a growth role or if they're unfortunately having to raise money for perhaps less positive means. I think it's a really good example of the role it can play, and I think going forward it's a really positive platform on which to build. Turning now to the next part of the agenda, which is a panel of experts I'm delighted to host for the next half hour, talking about really their experiences over the last 12 months, and more importantly, what changes they think are going to be ahead in terms of how businesses look at their strategy and perhaps look at their financing strategies going forward and raising money. So I'm delighted to welcome Jodie Burkett from Deloitte, Adrian Reed from Altium, and Javed Hook from Bullhound. Before I just go to the time-honoured tradition of asking them to introduce themselves, just remind you there is a Q&A after my questions. So if you want anything answering, then just put them into the chat box and I'll pick the ones that are repeatable and use those. But without further ado, if I can just get some brief introductions, and starting with Jodie.
Thank you, Anthony. Jodie Burkett. I lead Deloitte's transaction services team here in Manchester, and also sit across our clients and industries within financial advisory more broadly. So hopefully we'll have some experience to be beyond the Northwest as well to bring into a conversation in terms of what we've seen happen over the last 12 months.
Adrian.
Hi, yes, Adrian Reid from GCA Altium. I now head the Manchester office of GCA, a senior partner in our tech practice. Did a number of transactions last year, very focused on technology. Sit on our European strategy board, and interestingly, one of the trends is working more and more now with our international network. So calls last night with San Francisco, call this afternoon with South Africa and a San Francisco team. So increasingly global, but focused very much on the technology sector.
And last but no means least, Javed.
Yep. Hi, everyone. I'm Javed Haq. I'm a director at GP Bullhound. To give you some background, GP Bullhound, we're probably Europe's largest specialist technology investment bank. We're focused mainly on helping our clients raise growth equity capital of £20 million or above. And we've also got really good experience of selling businesses, typically to large West Coast giants like Facebook, Apple and Snapchat and those guys. And so globally, we're about 100 people around the world with 9 offices, including an office here in Manchester, which I head up on behalf of our efforts in the north of England.
Okay, thank you. Just coming back to you, Adrian. So looking back over the last 12 months, how has the advice that you've been given to your clients changed as a result of the pandemic? And I'm thinking particularly those clients who were either in a process or fundraising process in Q1 or had short-term plans in Q2 to raise money before any of the disruption happened.
Yeah, so I mean, I think like everybody, when the sort of lockdown happened, I think anyone who says they knew what to do is probably lying. We completed a number of deals just ahead of it, so it shows that getting deals done as quickly as you can is always valuable. We had a number of processes that were still sort of ongoing, and we ploughed on for a little bit during lockdown, sort of March, April time. What became clear was it was impossible to forecast how long it was going to happen, how long it was going to last, what the effect on the business was going to be, new sales and long-term trends, and the assumptions in any model around a financing or a sale just got thrown out of the window. So genuinely through from March through to maybe sort of June, July time, we were taking stock of those businesses, monitoring how they performed. A lot of people were arrangements. And then what became clear was there were certain businesses. We do have a consumer team down in London, which has done a lot in restaurants, travel, etc. Clearly that has been sort of very badly hit and hasn't come back yet. But the technology side of things, David, myself and a lot of people in the region specialise in, clear that whilst there was a slowdown and initial shock, really good businesses came back through it. They adapted their practices. Everybody went to remote working. It probably brought forward a number of trends around remote demos for software companies, rather than having sales teams who are constantly on the road doing 1.2 to 1.5 new business meetings a day. They could do 3, 4, 5 business meetings a day. Implementation became more efficient. The need for lots of travel changed. Companies, for example, we've done a number of deals in gaming. They were able to recruit much more internationally, and offices that they might have been looking to have on a satellite basis, they were able to access talent internationally. So once that initial shock had hit, what we found is from the summer onwards, it became very, very busy. So there was a local transaction, Mobisoft, I think it was called out earlier by Jane. I was in the Living Bridge portfolio. That was a business we've been preparing for a long period of time. We just monitored what was happening and how they were behaving, how the customers were operating over the sort of the initial lockdown in the summer. But that meant that with the trajectory of the business, we were able to bring it to the market. It had been well tracked by it was a principally private equity focused process. And then what we found was that pricing actually was probably higher than we had expected, because the business had performed well. It was very resilient, which is a word you'll probably hear a lot over the course of the next hour and a half. And that led to really strong appetite and lots of competition, and a great result for management team shareholders. And it ultimately went from Living Bridge to ECI. And we probably saw that theme across a number of the other processes, and the deals we did last year were Mitre, Finch and Cypher and HCM. So people are really important, and we'll come to that as a theme later. Software in terms of Mobisoft, Equitu, another software business in the digitalization of the construction industry. So all that shock and change stress tested businesses, but the ones that stood up to it very well have actually been able to execute transactions, and pretty much we've cleared the book from last year, and we're building that and bringing new businesses to market during the course of this. So I'll get other people's perspectives before I go on and on, as people know I can.
Thanks. Jody, from Deloitte's perspective then, obviously technology, I think, has been one of the sectors that perhaps has shown, oh no, I'm going to have to use the word resilience already. What's the experience been outside, to maybe some of the sectors that have perhaps been impacted most?
So we've seen, as Adrian said, and you mentioned clearly, an asymmetric response to COVID, and you have to really get extremely granular within each sector as to the winners and losers. Retail would be a great example for that, in terms of, clearly some perform very strongly. So we have seen, on that note, e-com. There is a significant amount of activity within e-com, e-tail, call it what you will, and the transition to that online with consumers' behaviour to move online. And our view, it was difficult for me to write this in a diligence report, but our view is that is going to be something that is sustained. Once behavioural changes are there, we do expect to see the experience, those bricks and mortar retailers that can bring the experience back, that will be absolutely demanded by consumers. But where there's been some transitioning to online, we do expect some of that to continue as well. So that's been an area where we've seen a lot of activity. Services is another area where we've seen a lot of activity, both in professional services and the broader market, and seen a lot of demand for assets in that space. Obviously, we talked about technology, we talked about telco as well, and within consumer and retail. That's largely where we've seen the real peaks in demand for assets. But it's what we have seen, and what Adrian would have seen and Jav would have seen, is sort of in the immediate aftermath of once we'd got past April, and then everyone had focused on really the safety of their workforce at that point, as we did, as well as all of our clients, was portfolio companies thinking about where they could make investments. So all the PE funds were sort of thinking about their portfolios, what white space did they have in terms of being able to grow, but that would be both in the high-performing sectors in terms of strategic growth, and in those sectors that were more impacted, thinking about how this was an opportunity to grow scale at what would hopefully be reasonably priced assets, to then when they bounce back out of the pandemic after that.
Okay, thanks. Yeah, and I suppose going forward then, both from a financial investor point of view and then also strategic investors, Javed, do you think that investor appetite is going to change because of what's happened over the last 10 months in terms of risk and what they look for in terms of potential investments? So, you mentioned some of the strategic partners that you've sold to historically, Facebook, Snap, those people. Do you think those sort of investors are going to change how they approach M&A?
I don't think they're going to change. Again, I can only really speak for the technology sector, but I don't think there's going to be any particular change in the way that people approach investing in the technology space. The appetite to invest in the space over the last 12 months has just accelerated quicker than we've probably ever seen before. I think that investors are really starting to realize that technology is no longer, a high risk asset class to be putting their money into. And we just fully expect this trend to continue. And you can see this by the fact that, all of the big specialist technology funds have raised huge amounts of capital over the past couple of years. And some even managed to raise funds during the middle of the pandemic, like a TCV or an Insight, for example. We've also seen what I class more traditional private equity funds to start bidding far more aggressively on technology opportunities as they want to move into the space as well. I think Adrian did a great job with Mobisoft in that respect, because I think the price that ECI paid for that was much more in line with what you'd expect a technology investor to pay than a kind of traditional private equity investor. And then we've also seen a huge increase in appetite from strategic parties who are in turn backed by financial buyers themselves, almost picking up on what Jody said there, in the sense that these funds looked at their portfolio companies when the pandemic hit. They made sure they were well funded to trade through any circumstances that they faced. But then they wanted to back those companies to make acquisitions, to fill in those white spaces that Jody mentioned earlier. And then finally, we've also seen a big increase in the amount of corporate venture activity taking place in the market. So these are strategic companies who've set pools of capital to one side in order to make strategic investments into really interesting, pieces of technology. So for example, we helped an autonomous driving software company raise $50 million late last year, beginning of this year. And that was led by BP Ventures and supported by a long list of other strategics who just wanted to have an interest in something as exciting as autonomous driving.
Okay. Adrian, then, in terms of the strategics then, and really looking at outside of the technology sector, there must be opportunity for, if not distressed sales, but also, opportunistic acquisitions.
I mean, I can talk less for the outside the technology sector, I'm afraid. I mean, what I would say is actually what we've seen is a flight to quality, and everybody always talks about this every year. There's this annual conversation about basically, the sort of the haves and the have-nots. In that distressed market, there will be certain people who pick up certain distressed assets. I think it was highlighted a lot around e-commerce and what Boohoo have been doing, picking up high street retail brands, but ditching the high street bricks and mortar element, keeping the brand and using that for distribution. I think there's that sort of element of distressed activity. But at the moment, people still don't quite understand. If it isn't a business that, again, I'm going to keep breaking my rules, has shown that resilience, then people don't know how to price things. So if it's a good business with good trajectory, maybe it's benefited almost, you can't have benefited too much from the pandemic, because if you have, then almost you're trying to sell off a bubble in terms of performance. But I think there's less of that at the moment. I mean, it'll be interesting over the next 6, 9, 12 months how the travel sector picks up, because there are going to be some winners and some losers. There's going to be a similar, some of the stronger backed assets, the ones which are listed with access to capital, are they going to do a similar thing where more of that travel sector is consolidated? I don't know. That's something which our team down in London who focus on that space are tracking very carefully. What I would say again about that point about quality, that selling the premium assets, there's more money now chasing an almost never smaller pool of high quality businesses. So that's what's driving what we're seeing in the market at the moment, more so than any of the distressed elements.
Okay.
Outside of technology, Anthony, just in terms of what we're seeing for strategics, what Adrian just mentioned there in terms of knowing how to price the assets, you would think that the strategic investor at this point in time would have a better view of how to do that and how the targets may respond post-COVID, and what the bounce back might be. So therefore, they're at an advantage there. I also think if you go way back when to the global financial crisis, those businesses that came out strongly were those that had in the right way made the strategic investments and looked to grow inorganically as they came out of the crisis. And the last point is our CFO survey points to the highest level of optimism we've seen in 12 years, which is perhaps unexpected, but when we did that in January, with a particular appetite to invest.
Okay, so does this mean that for, let's say, startups or scale-up businesses that are looking to raise, then there's a lot of positivity out there? There's a lot of, obviously coming down to the quality of the business. So, do we think that it's a good time and there's lots of opportunity for those businesses to be raising money?
David?
Did I pick that one up first?
Yep.
I think the opportunity to raise capital, as I mentioned before, is really strong. There's so much capital available at the moment, but as Adrian said, I think people are looking for the best companies. They're looking to back those companies big, as opposed to deploying that capital a lot across lots of different companies. And a bit of a controversial statement, but raising capital should be hard at a growth stage, because you need to demonstrate to people that are investors that you've got a strong proposition in front of you. And if you can do that, then the availability of that capital is really strong. So at the lower end, you've got lots of great EIS funds like Foresight and YFM and MVM, who are helping that earlier stage business raise money. I think the more traditional funds are also putting pools of capital to one side in order to invest at an earlier stage into companies. So the availability of capital is definitely there. And now is as good a time as any to start raising capital, I'd say.
Okay.
Yeah,
I think sorry, Adrian.
Anthony, I was going to add to that. I mean, I think actually it's quite interesting that there's almost a drawing of a line. The purity of the technology, I think, is going to be increasingly important for raising money for earlier stage companies. So this cloud from the start, 5 years ago, we were talking about sort of SaaS transitions. Now the businesses that are coming on through, they are either relatively new businesses that have matured quite quickly and benefited from the pandemic. There's an increasing number of companies getting to real critical mass where we're talking about the ARR and recurring revenue getting to 10, 20, 50 million. And in those businesses, their ability to be cloud deployed, a true SaaS model in terms of subscription pricing, flexible and nimble to move around some of the more traditional players in the sector. And we're seeing that across lots and lots of different horizontals, but also verticals in the software space. And that is I think that's going to be a trend everybody's going to have to look at. And there's the other point alongside that. I mean, Jodie mentioned services, digital transformation. A lot of the larger organizations are having to embrace digital transformation, how they move their data, their technology, how they keep up in terms of their communication with the clients and even with their employees into a digital environment. So I think those trends are really have been reinforced and cemented. They've drawn a line with maybe some of the more historic businesses that have struggled to come through, and we're seeing that in the sort of the high street space as well. And that's just something we're going to see more and more of.
Okay. And Jodie, just turning to, I think I'll just picking out a couple of things that came out of the report, and in terms of some of the debt financing that's been that's been used. How do you see the debt market?
I might have to Aidan and Jav a little on this, but in terms of, I was conscious that one of the things we haven't picked up on is accessibility to financing, accessibility to debt. So that was something that we immediately saw drop off in terms of accessibility in Q2, and pricing went up and covenants went up and everything shifted into the less accessible. But that very quickly bounced back into normality and where we were before. Clearly in those sectors where they could demonstrate the sustainability, let's bring another word in, the sustainability of that earnings profile. And that's continued, that's the experience that we've had. The accessibility to debt is there. Adrian or Jav?
I agree, and we've got a big debt team down in London, also one over in Germany. Again, same happened. Lockdown happened, everybody shut down. There was a lot of sort of wailing and gnashing of teeth, assessing portfolios. We thought there was going to be a tightening up of debt appetite. There probably has been a little bit in maybe the sort of the senior high street lenders. I'm sure there's some of them on this call who might disagree. The credit funds, though, often had more exposure to the more sustainable recurring revenue type technology assets. And the availability of financing for those good businesses has been phenomenal. Interestingly, though, what we saw at the back end of last year was a lot of the transactions were equity bridged. So the private equity firms were getting confident that there was going to be debt there for them as and when they needed them. What they would probably do, paying that price, they were prepared to go all equity early on and look to refi. So I think there will be quite a decent wave of refinances in the first half of this year, of deals done particularly in the technology sector last year, and that appetite is definitely there. But it's the same trends that we'll carry on going on about till we're blue in the face and you're sick of the sight of us.
Yeah, I think one other thing to add to that would be the not emergence, but the increase in the number of venture debt funds that there are in the market at the minute. So I think there are more debt providers taking a more aggressive view on earlier stage software businesses in particular, whereby they're willing to lend against multiples of their ARR, even though those companies may be loss making or break even at the time. So that's just interesting to provide a different source of capital for those earlier stage companies as well.
Okay, and I think another point that came out of the report was the IPO market and the expectations for that going forward as well. Do you share the views that IPOs are going to become increasingly popular with perhaps businesses that have different sort of different metrics than traditionally?
I mean, definitely. I mean, people saw The Hut was a fantastic sort of local success. And we've got 4 IPOs on the moment. The 2 largest are both in e-com. So that e-commerce space, like the Hut, but following through into different types of categories, is clearly accelerated. There's definitely an appetite on the markets for new listings, as we heard earlier. There's a real dearth of technology companies, software companies, as types of deals that we, Javid, do as well. So it's actually quite hard to bring those to the market because of the availability of debt financing, of the willingness of specialist global software investors to pay high revenue multiples, EBITDA multiples, sometimes in the mid 20s and plus, etc. So yeah, IPOs are definitely, there's a lot of congestion, and seeing, I think we're going to hear from Richard later. I think there's going to be quite a lot of congestion, and we'll see whether or not the market gets indigestion up to the summer, and then see the long-term sustainability of that IPO market, which is always something we've always seen. Whenever a window opens, there's a rush into that window, and often then a pause for breath.
Okay, and Javid, and Javid, I think just touching on the IPOs and the focus on growth funds and sort of the government's approach to it. So if you look at like the future fund that they introduced to provide support into high growth funds, and then also the high growth sector of the exchange that hasn't been used, but obviously PensionBee, who are a reasonably high profile company, are looking to IPO using that part of the market. Do you think that's going to be an area that we'll see more, smaller real growth companies use as a means to access capital?
I mean, look, from our perspective, we don't do a huge amount in the IPO market, so I can't speak to that with any great authority, but what I would say, and I'd echo what Adrian said, is that there's so much private capital available in the market at the minute that it provides a very strong alternative to going public for earlier stage companies in particular. So in technology, a lot of the time you consider an IPO to be a really successful way of exiting the business, but that typically comes after multiple rounds of financial investment in the first instance. So in the technology space, particularly for earlier stage high growth companies, before they've delivered profitability in particular, we tend to see those sorts of business staying in the private markets to begin with, but it will be interesting to see to what extent public appetite goes after those sorts of opportunities in the short term.
I mean, I would reiterate that as well, and not wanting to upset anybody on this call. I think smaller, higher growth, particularly tech companies, high growth companies, should stay private for a period of time. I think it's easier to grow. It's easier to see the growing pains, depending on the type of revenue model they've got. They can be sometimes a bit lumpy. It might mean that you don't make the investment that you might need to in scaling your sales team, into building new modules in terms of the platform, etc. So from our perspective, the IPOs, the companies that we include with where IPO is an option for exit, they're actually getting bigger and bigger. A threshold of 100 million 3 or 4 years ago is probably a couple hundred million, with more like 100 million free float now, and we're talking about ones which are 300 million and sort of 600, 700, 800 million that we're looking at now, where it's having greater critical mass makes it more appropriate for the listed markets in our view, but there is still a way that you can use the markets for that in the right circumstances.
Yeah. And Jody, is that something you share? If you've got customers who see all the media splashes of IPOs and money being raised, and they're coming to you saying, why aren't I doing this?
Yeah, absolutely. I mean, the only thing I would add, we know that pipelines across Adrian and his competitors are very deep, and it'll be which can get over the line sort of pre-summer, as Adrian said. But we are seeing that scaling up as well in terms of the organisations seeking the capital markets, because it's not the right answer for everyone, which I think is sometimes overlooked.
Okay. And I think if we're talking about government support on the Future Fund, just generally in terms of the government support that's been provided to companies over the last 10 months, starting with Adrian, do you think that they've done enough there on your personal view, and what do you think the unwind's going to look like?
Well, I think I don't want to be political. I think actually in a difficult circumstance, they've probably done as well as they could have. You could criticise around the areas. I mean, the supports, the initial sort of CBILS and all the various loan schemes, they were quite tricky to access. I'm not sure. I don't know what the detail is on the statistics of how much they were taken up. Furlough has been really important for that consumer travel sector that's been hit very hard. A lot of, I mean, what you'll find actually linking back to the IPO, that there's been a wave of the big listed companies who took furlough money actually paying that back. I think for a company coming to the market now, which is looking to exit, provide liquidity for investors, management teams, if they've had a large amount of furlough, that's probably going to be disclosed. I would imagine they're going to pay that back as part of that process, which shows it was made available to all, but certain people didn't need it as much as others. And most of the companies we have dealt with haven't needed or benefited from it as much. So it's a harder one for me to answer.
I mean, outside of the technology sector, pretty much every business we look at has had some form of benefit from furlough, and that is, I'm not being political either. I know there've been gaps in funding, I know it's been difficult, etc. But the way that the furlough scheme was set up in speed, having not had a system like that previously, whereas other geographies had and were able to leverage that, was set up at speed, and the cash was flowing quickly. And clearly, it's been quite complicated in terms of the tapering, and then having to reintroduce it when told that it would be finishing sort of end of October. So I think that was very well utilised. I think the listed businesses, we did see, as Adrian said, a number of them paying it back. I think that's probably will have happened by now, as those that are going to do it. But when we're going through our diligence, it's certainly high on the list of we've been working a lot with strategic investors, high on their list of demands to understand how it was accessed, was it rightfully accessed, because there's an expectation when you talk about unwind that HMRC will now have the capacity to scrutinise the claims that were made and the record keeping, etc. I think as a concern in relation to the funding that was made available, whether it be CLBILS or CBILS, because the lockdown and those impacted has gone on for longer for those impacted sectors, the access to funding worked at the time, but actually we're going to come in a position where it's going to start amortizing, and the earnings coming back into business haven't happened because lockdown is still there. So when they need to be in some way refinanced, that's a concern.
Okay, thanks. Okay, so crystal ball moment now, just as we're finishing off. So I'm going to ask you which areas you are really excited about over the next coming years, in terms of an area you think is going to grow and has got a lot of potential. Javed?
Well, I've obviously got to be biased towards the technology sector because that's all I know about. But I guess.
But within the technology sector.
Within technology, I think there's two things I'm quite excited about. One, on a sort of global scale, is what's going to happen with social media platforms going forward. There's been a lot of controversy around social media over the last 4 years in particular, and we've seen some really interesting new ones set up, particularly over the last 12 months, which are kind of targeting people in a more niche way. Are they being more transparent in terms of their data usage? I mean, you're really interesting to see how that impacts the performance of companies like Facebook and Twitter. So everyone's seen TikTok and House Party grow like crazy last year, but you've also got some new ones like Clubhouse, which has gone from nothing to $1 billion valuation in no time whatsoever, providing alternative, platform for people to consume media on. So that's going to be really interesting. And then locally, I'm really excited about enterprise software in the northwest of England. I think there's a really great pool of talent in the northwest. I think we're producing more and more of our own engineers who are going on to create great products themselves. And there's some really meaningful businesses starting to be built in the northwest, like Matillion or Mobisoft or Connect One. And I think that as people recognize the quality of life that you can have up here in the northwest, I think that trend is going to continue. We're going to build great software companies.
Great answer. Jodie?
I would say any business which supports the ESG agenda. So we are seeing fund upon fund being raised, which is prioritizing ESG above all other. EQT, for example, Citigroup and pension funds all looking at it. And which sectors do I think will where would I see? I'd say consumer, in terms of where I expect to see those two trends come together. So you see lots of the large consumer product companies making their statements around net zero emissions and the time frame to that. I think any business that is involved in supporting the ESG agenda is where I'd place my bets.
Okay, thank you. And finally, Adrian.
Yeah, I'm a little bit biased, like Javid too, but I mean, in technology, I think there's a couple of areas. I mean, new finance and new finance platforms, we're seeing a lot of that coming through, how that works, new payment methodologies, faster payment platforms, global payroll. The other area as well, which we've done a lot in, but I do think is very topical, is HCM, human capital management. So how you communicate, how you train, how you look after the well-being of your employees. It's very, very difficult. We haven't mentioned talking about the Zoom platforms, the Teams, and all the variations that we sit on here, but just managing the workforce and seeing how the workforce unwinds back towards an office environment, or whether or not it stays very much work from home, more remotely, less travel, but also how you then keep communicating with those. So we've looked at a lot of businesses a bit more like the Slacks, which is over the top of how you engage in terms of a cultural culture within a business for the staff, but also connecting that through to the customer engagement piece. I think is going to be a really interesting area to watch over the coming years.
Oh, that's brilliant. Okay, well, we are up to time. In terms of questions, we were so good, there weren't any. So we've obviously answered everyone's questions completely. But I'd just like to thank all three of you for sparing the time and putting up with me as a host and sharing your thoughts, which have all been really interesting. We've now got a break for 10 minutes. I think we come back at 1:05 for the next panel. So once again, thank you very much.
Thanks,
Thank you very much.
Thanks for having us.
Hello everybody, right, okay, we're coming back. I hope you are all suitably refreshed and ready for the second half of today's lunch. A huge thank you to all of our speakers before from the International Stock Exchange for their sponsor video and their welcome, to Jane to go through the report, and obviously to our panel hosted by Anthony Morrow. Thank you to them. I'm now going to hand over to Simone from EY, who will be hosting our second panel, and she will be joined by Jeremy, Jessica and Guy. So if I can hand over to you, please, Simone.
Thanks, Sam. Hi, I'm Simone Masterson. I work at EY in the Transaction Services team based in Manchester. We work primarily across deals in the Northwest, focusing on technology and e-commerce sector. So this panel now is going to focus on supporting startup and scale-up businesses during the pandemic. So I'll hand over to the panel now to introduce themselves. Jeremy, would you like to go first?
Sure. Hello, everyone. Jeremy Cole. I'm the managing partner of the imaginatively titled Cole Associates Corporate Finance. We're based in Manchester, started in 2002, and we advise clients generally trying to do one of three things: either acquire a business, which would be a corporate acquisition or a management buyout, or grow a business, which would be raising growth capital, or selling a business. We operate in, I think, what's called the lower mid-market, which is businesses from startup through to around about 100 million turnover. We're sector agnostic. We work across pretty much every sector you could imagine, although I've always had a soft spot for high growth businesses and tech businesses, because I had 3 years working in PwC's Silicon Valley office in an earlier part of my career.
Great, thanks, Jeremy. Jess, would you like to go next?
Yes, good afternoon, everyone. I'm Jess Jackson, and I head up GC Angels, which is the leading early stage investor in Manchester. We take part in first-time rounds and seed rounds, ranging from anywhere from 100k up to a couple of million in the kind of early stage market cap. I guess I'll talk to you a little bit more about the size of our portfolio in a bit. We're pan sector. although typically digital, creative and technology is a common thread that runs through the entirety of our portfolio. And we've supported 51 investments since we started probably about 4 or 5 years ago. And again, I'll go into a bit more detail about our recent activity in the course of the questions today.
Great, and then over to Guy.
Afternoon, everyone. My name's Guy Weaver. I'm from Prichora Ventures, so we're a corporate venture capital firm based here in Manchester, focused on early stage investing. So over the last 18 months, we've just over 20 million into a range of early stage businesses, predominantly tech, but also biotech and life sciences.
Great, thank you. So if we start now with just to hear your views really on how the various sectors have been affected during COVID-19, and maybe if we start with how has the early stage investments been affected in the past year, so the first time raises and seed rounds?
Shall I go first? I guess I would break it down to look at the supply side and the demand side. So from the supply side, going into the pandemic, a lot of the VC funds had raised additional funds fairly recently. So they were sitting on war chests. Also, there were lots of private investors and EIS funds looking for good investment opportunities. So unlike the 2008-2009 recession, there was a lot of funding out there going into this situation. I mean, on that supply side, obviously investors moved into a much more cautious mode. The VCs had some issues within their existing portfolios that they needed to address, so that occupied a lot of their attention. And private investors, particularly EIS investors, were very, very cautious in the second and the third quarters. Having said that, all the local VCs like Maven, YFM, Mercia remain very active, and Prichora, and the money was still there, albeit more cautiously. I think on the demand side, high growth businesses, startups, scale ups, a lot of them that we spoke to had a kind of presumption that it was not a good time to try and raise funding in even the fourth quarter last year, but certainly the second and third, and that was understandable. But my advice to a lot of them was at least start the process, open the dialogue with the investors, prepare to go to market, get your story right. Even though forecasting was massively difficult, at least open the dialogue and get yourself into the pipeline of the investors, because when better times come around, as they did do later in the year, the people who had already started those dialogues and had started the relationships were at least at the front of the queue. And I would continue to advise entrepreneurs and growth businesses to engage with the investors, even though you might have to allow for a longer period to actually get through to the investment in place.
Yeah, so I think from our side, most of what Jeremy said is absolutely right. So we're seeing that, it's been the biggest year-on-year sort of drop in terms of the amount of equity finance that companies are raising, or rather not the amounts, but the number of companies that are raising. I think it was just under a 20% drop from 2019's numbers. And we already know that startups and scale-ups that were kind of already, had already received funding were sort of okay and relatively insulated because they had access to that capital, and also investors are more likely to shore up their portfolio than they are to be looking for new opportunities. Although it has to be said, I think they've been incredibly helpful in the early stage space. But quite frankly, as is always the case, businesses that have never raised funding before have really, really struggled through this pandemic. So they've not really been able to access any of the government support. So they didn't qualify for Future Fund. They weren't really able to demonstrate any of the turnover trajectory that would allow them to access things like CBILS, for example. But it's the frustrating thing for us, and is, you know, we're a public fund, so we're very much targeted at this stage, and it's so important that we have a busy seed stage, because this sort of seeds the funnel, excuse the pun there, for the later stage market, and it's where we start to see, you know, the most exciting technologies, jobs getting created, and innovations happening. Obviously that is a huge concern for, and will be a huge concern for, the government as they set budgets for next year. And it's, you know, it's where a lot of the economic growth will come from. So it's really important that we all keep our eye on it and do what we can to make sure that the seed stage remains active.
From my view, it's quite interesting, Javed saying there is quite a lot of private capital about in the market at the moment, because I think at the early stage that just isn't the case. Because to give you an idea of our pipeline at the moment, we see approximately 120 new opportunities to fund every single month. So that equates to about 2 billion of funding opportunities we see a year. And we only invest about 1% of what we see. Interestingly, looking at the stats for the Northwest, in 2019 there was about 286 early stage deals, and in 2020 there was 243. Now, actually, whilst that's a decline, I think there's a couple of things that are actually masking some of those numbers in the market. So one of those things is the Future Fund. So the Future Fund's announced what they've actually funded into our region, which is approximately 52 million of the billion of funding that's been provided through that scheme. So that's generally going to be 50 odd deals that haven't actually been picked up in the data because future funds aren't really announced anywhere. I also see at the moment there's quite a lot of businesses doing advanced subscriptions. So actually this is to take valuation off the table, and actually advanced subscriptions again aren't announced. So I don't think there has been, if you factor that in, I don't think the decline is as much as what we've seen in the numbers coming through. But what we would expect is the Northwest has a thriving early stage community, and you would be expecting the number of deals to increase year on year, and I'd expect it to increase year on year by about 20%.
Thanks for that, Guy. And maybe just what do you think about the lack of events as well? What impact do you think that's had, you know, not being able to go out and meet people like they usually would when they were trying to source funding?
I think, you know, I don't think it's necessarily a lack of events. I think actually it's safe to say I think there's probably more events. It's certainly allowed us to be a bit more agile with running our events. So usually they would be sort of at least half-day affairs for us as a team. So you know, getting to a venue, securing a venue, setting it up, welcoming people, then trying to get them to sit down and watch some pitches, and then get that networking piece afterwards. And I think actually it's that latter part that is really missing and really difficult to replicate in any way digitally. It's those kind of, you know, whether it's just a networking event or a thought leadership event, not necessarily pitch events, where you kind of have those organic opportunities to say, oh, I'm really glad you're here actually, because there's someone here that I want you to meet. And those kind of really organic interactions, just really, really difficult to replicate. So I don't think it's a shortage of events. I just think it's really hard for these virtual offerings to replicate that organic networking and bumping into people that you would otherwise maybe not collaborate with as much.
Yeah, I'd agree with that. I think investment is fundamentally a judgment about humans, making an assessment based on face-to-face communication. Obviously, Zoom, Teams, etc. has been great, but it's a poor substitute for face-to-face communication in all its various ways. I think also, whether it's networking or it's a one-on-one coffee between an entrepreneur and a VC or an investor, it's often not that first interaction that's important. It's the second or the third iteration of that. It's the referral to a friend or a friend of a friend, and another meeting. And to the extent that happens face to face, it's immeasurably better than virtually, in my view.
I totally agree. I think it's the chance meetings that you can't actually do on a virtual event, because virtual events are all in the networking. You're trying to find people to network with that might help you, not those people you bump into. Like, as an example, early last year, I went to an event, actually found myself sitting next to one of the heads of NHS Digital, who then I got his name connected to Dr. Fertility in our portfolio. Well, that wouldn't have happened had I not sat next to that person. And I think, particularly at the early stage, those chance meetings and that bit of luck can really propel the business to the next level. And I think that is what a lot of businesses are missing out on at the moment, particularly at the stage we work at, and look forward to when that comes back.
Great, thank you for that. And now just moving sort of outside of the Northwest, how do you think the Northwest has performed versus, nationally? I don't know if Jeremy, you want to lead on this one.
Sure. Yeah, obviously everybody's suffered to a greater or lesser extent. I think the Northwest has performed relatively well. I think the pandemic has been a bit of a leveller compared to the normal dominance of the Southeast. For example, rather than having to jump on a train for 2 hours to go and see a VC in London, it's relatively easy for a Northwest business to get some access to those VCs quicker through the virtual means. Also, we have our well-known success stories, Boohoo, AO, The Hut, etc. But down at our level, if you like, I think the Northwest has done relatively well. As I said before, supply and demand, we've got VCs, plenty of very active VCs in the Northwest, who are sitting on pots of money ready to invest. Northwest has always had that pioneering culture going back to the Industrial Revolution, and it's well known for its entrepreneurial spirit, the feeder universities, the talent coming out of the existing high-tech businesses and unis, the sort of infrastructure of advisors that exist in the Northwest. So all that's been a positive. Having said that, fundamentally, I think the lesson the last 12 months has taught us is it's all about sector, much more so than it used to be. And I think that will be the theme for at least the next 18 months, 2 years. It's going to be less about the quality of your management team, which always used to be the standout kind of judgment for a VC or an investor. And it's going to be primarily about sectors. And that's not just the sector that the business itself is in. I think these days you have to judge how robust, so I'm not going to use the resilience word, to judge how robust a business is these days, you have to kind of look through its customer base to the customers of the customers and to see how resilient or robust businesses are. And often they're surprisingly robust, and that applies to the Northwest and nationally. But generally, I think, yeah, it's been an awful 12 months for a lot of people, but I think the Northwest has fared better than most.
I would sort of pick up there on Jeremy's point, which is very well made around kind of it does, you have to look at sectors really. And one of the things that is worth highlighting, because I don't think we talk about it enough, it's all well and good, and tech is huge for us here, as it is in most places. But the Northwest, and particularly Greater Manchester, is huge for the creative industries, and that has just been absolutely battered by COVID in some of those subsectors anyway, whereas others are absolutely thriving in the current environment. So with sort of digital content opportunities, for example, esports and gaming, huge. We've got nothing but time and spare money on our hands now, compared to if we were in a normal scenario. So we're spending it on trying to distract ourselves from what's going on, or rather not going on in our world at the moment. And I think it's really important to highlight that we've seen a real uptick in these creative opportunities, going, oh, you know what, actually there was an opportunity here, and how can we sort of break into being talked about? So I would highlight that if anyone's sort of going, yes, hearing this, we'd love to talk to you more about creative. But I think for the Northwest as well, we've seen an increase in VCs, or indeed anyone who is looking for new sources of deal flow, really picking up on some of the really strong PR that Manchester's been getting, I think, in the last sort of 2 to 3 years around becoming a tech hub. And with not being able to actually physically come here, or in fact, maybe even an unwillingness to put boots on the ground, they're looking for the easy wins to sort of tap into deal flow. So we're getting introductions, direct approaches from people who are angels or who are looking to deploy funding or build a footprint in Manchester, and be like, where do I even start? And that's fantastic news for us, because that's how we kind of see our role in the ecosystem, is about connecting those people with live opportunities now that we've already to some extent looked at and triaged. So that's another encouraging thing for us, but also I think for startups as well.
Yeah, I'd echo that absolutely. I mean, I think it's going to be a mixed picture wherever you look at in the economy, and whether that's the Northwest, whether that's London, whether that's Scotland. I think we've got to focus on what the Northwest is strong for. So one of the big things we're very strong for, as mentioned earlier, the HUT IPO, you've got AO. We're really strong in the region in e-commerce, and what that is doing is there's a number of early stage businesses focused on providing technology to those e-commerce businesses, and I think the Northwest is really strong in that area. You've also got the likes of GCHQ that came to the Northwest. We're expecting to see a number of really good cyber businesses coming out of that. And the Northwest is strong with Alderley Park, with health tech, biotech. So we've got a lot of positives in our region, and those businesses are doing really well. So what I'd say is, I think it's been a mixed picture. I'm not sure we can compare region to region. I think there's good pockets, there's pockets that have been affected, but overall I think the region in the early stage has done really well. I think it's just been held back, as Jess said, with lack of funding.
Great, thank you. And then how have you helped your investments or clients overcome burdens they face? So specifically, like, what extra help have you found they've needed over the last year, and sort of what areas have they needed that in?
I'd break it down into different phases within the last 12 months. So April, May time, I think for a lot of businesses, it was about going back to real fundamentals, about cash flow management. Is a customer who you build in February actually going to pay you? Having a long, hard look at your headcount, and really getting down to basics in terms of battening down the hatches. I think as the year moved on, we came out of the first lockdown, then a lot of businesses, again, it depends on sector, but for a lot of businesses, it was about moving from adapting and surviving to more, not so much thriving, but trying to make the most of the new world and to plot a route out of it. And again, from a funding point of view, a lot of funders in that period, kind of during the summer, say late summer, they were keen to try and do things, keen to invest, keen to lend, but they wanted data, positive sort of post-lockdown data to latch onto. So that was a slightly different phase to the sort of April-May phase. And then I think from kind of August onwards, in line with other advisors like us, we've seen just a surprisingly high level of engagement with investors, with companies being acquired, which is great. And again, doesn't apply to all sectors, but maybe there's kind of inherent optimism and positivity with investors, business owners, purchasers, and that's been great in the final quarter, and hopefully will continue into the new year.
I think from my side, we're as a VC investor, we're very much a supportive funder. I mean, our strapline is more than money support, so we actively support our businesses, and actually we've we've done a hell of a lot during 2020 and supporting the businesses during the COVID lockdown. Interestingly, one of the biggest areas of supports we gave our businesses was around HR and actually giving our portfolio access to our group HR support. And that was from everything about well-being, because it's all been about employees first and making sure employee welfare is the number one agenda item. But things like appraisal systems, advice on if companies are looking to do furlough. But the other things that we very much help on is we've been implementing CRM systems, Power BI over the top of that, developing sales teams, branding. And actually one of the things where a number of our businesses are now putting in is OKRs in terms of driving the business and driving that strategic direction to really connect the business and give that visibility across the business. So we've put that in place at our business. It's working really well, and we're taking the learnings from what we've done into our portfolio. But as Jeremy mentioned, it has also been about cash. We've managed to find over $1 million of cash savings from our portfolio last year. And that's not come from cost reductions. That's just working smarter, buying smarter, and reviewing things like R&D claims. So I think there's a lot early businesses could do to look at cash savings. It doesn't have to be cost cutting.
Yeah, the only thing that I would add to that, because I'm going to let Simone move to the next question, is actually, although startups are usually seen as kind of the most risky stage in the market, and indeed they are, what we saw as a result of the lockdown was, the rationale for their funding rounds was to build their technology. So really their 12 to 18 month kind of plan was relatively unaffected. They just sort of had an eye on, okay, let's kind of see what the trends are from a buying behavior point of view in our market. But largely it was relatively well insulated, and they're lean enough that they can scale down quite quickly. We've also been involved in sort of strategizing when might be the best timing for the next round, and utilizing smaller chunks of money, bounce back loan, or an angel investor buying in for 30, 40, 50k kind of level, that just gives them maybe that 2 or 3, 4 month runway extension, such that they can be in as strong a position as possible when they do go to market.
And then just think about diversity in the market as well. So, there's big focus at the minute, increasing diversity in the workplace, any more senior positions. So how are you finding this with the investments that you're approached by? Would you say it's moving at a similar pace?
I think so. I think when we spoke about this in the prep, I sort of said that 2019, I think, was the year of talking about women in the context of funding. There was a lot of really high profile reports. So the British Business Bank's report, and then there was the Rose Review, of course, which had really clear recommendations, tapped into some fantastic data, which allowed for funds to sort of see how they were performing versus the average, but also set out some really clear recommendations on what they could do to see this change. And indeed, a lot of the work that we've been doing has been building on that. And we've joined a kind of a partnership group called Fund Her North, which Praytura are also a part of, as well as lots of other really prolific investors across the entire of the Northern Powerhouse footprint, to deliver on some of those streams of recommendation. So very crudely around kind of engagement, around fostering collaborative networks, and then actually doing the investments and the transactions themselves and facilitating introductions. And I think 2020 was the year that sparked a lot of conversations across every part of our world, really, when it comes to ethnicity, and particularly with Black founders. And I'm encouraged to sort of see that there are specific funds that are emerging as a result of some of that activity. I think that is focused on London, as far as I've seen, but I would really love for those to, again, come and see some of the talent that we have across the north as well. I think it's where the diversity agenda on the ethnicity front has not delivered for me is data. There's not been any encouraging data or any data whatsoever, actually. It probably won't be encouraging, let's be honest, in which we can sort of see what the true picture is. Although I think it's fair to say we kind of know that the recommendations will probably be somewhat similar with a slight nuanced tweak. So I'd really like to see some of that data done. The British Business Bank did do a report called Together Alone report, I think it was. But it just highlights what's really obvious to us all on this call, which is they struggle with access to early stage capital. And if you also happen to be a woman and Black, you're going to struggle to a much greater extent. But again, it was just quite thin in terms of data from a VC level perspective for me, for us to really use it as a tool to build on.
Great, thanks for that, Jess. And I think just looking at time as well, I've got 2 minutes. So maybe if we just think about the future. So, you know, the market's still really buoyant in the first month, second month of 2021. Do we see this continuing into 2021 throughout the year?
I hope so. Yeah, I think if you go back to the fundamentals, there's lots of funding in the system, as it were. Lots of investment looking for a yield. So that's a positive. I think there are obviously some sectors where the last 12 months has accelerated changes that would have happened over the next 5 or 10 years. Everybody's familiar with those. There are other sectors like hospitality and travel and the creative industries, particularly the performing arts, where they've suffered horrendously. But once we're all vaccinated, then hopefully there'll be a massive bounce back and a resumption to something close to normality fairly soon. So no sectors that will be fundamentally damaged below the waterline. So yeah, obviously we're still in lockdown, so everything is still very difficult in terms of forecasting your business forward, but you'd have to hope we're through the worst of it, and the funding is there and the demand will surely come back as the rest of this year progresses, although I have been accused as being a hopeless optimist, but that's my perspective.
Yeah, the one reflection I would just make on that is we often see a flurry January, February, March, obviously tax year. So I think it would be interesting to compare Q1 with Q1 of 2020 really to really see. It will be a hell of a lot lower than I think the trend was previous to that, but it'll be interesting to compare those two data points.
I agree. I think with the confidence coming back in the market, we all hope investor confidence comes back and there's more money going into the early stage sector. I think it's certainly where the squeeze has been in 2020 is those businesses that are kind of between the seed stage and $1 million ARR, because a lot of VCs have sort of stepped to $1 million ARR as the limit. So we're seeing a lot of competition for businesses that are 2 million ARR plus in terms of rounds, but not that much below $1 million. So look forward to that coming back. I think we're going to see a lot of positives in the Northwest. As I mentioned, around the sectors were strong in e-commerce. We'll get stronger in cyber. And interestingly, I touched on it before in terms of how the Future Funds deals has maybe had an impact on deal statistics. I think a lot of Future Fund deals were done as bridging rounds last year, and those bridging rounds will need to be converted. So I expect to see quite a lot of activity in the early stage sector towards sort of Q3, Q4 this year, as the delayed rounds and advanced subscriptions need to get converted. So I'd look to see a real pickup in activity in Q3, Q4 this year.
Thanks, Guy. Well, with that, that brings us to the end of the panel. So thank you to all our panelists. It's really interesting to hear all your thoughts and actually the positives that have actually come out of 2020 as well. And Jeremy, I hope that you're right with the third time lucky, and this is hopefully the last lockdown we're in. So with that, I'll now hand over to Anthony, and we can hear from Richard.
Simone.
Thanks, Simone. Yes, and thanks for the panelists there. Really interesting chat. Now, just bringing the event to a close, and I'm delighted to welcome Richard Hughes, founder of Zeus Capital and one of the most experienced financiers in Manchester. We're going to have 20 minutes having a chat, and no doubt him sharing his thoughts on not only what's happened over the last 12 months, but also what's going to happen over the coming years. So welcome, Richard.
Hi, Anthony.
Hi, how are you?
Yeah, good, mate. You?
Yeah, not too bad, not too bad. Just before we start, there is a Q&A opportunity here. So if you want to get your questions for Richard into the chat box, I have a pretty light touch filter. So as long as none of the questions are incriminating, they should make it through. I
don't care, Anthony.
So how has the last 12 months been for Zeus?
Well, if you go back to COVID, really, in the start of COVID, I don't think there's any businessman who wasn't frightened, really. You know, we had the most bizarre situation hit us very quickly, where businesses were just being forced to shut down effectively and send people home. And, you know, at that, you know, the stock market fell through the floor. So my equity portfolio went down by about 50%. And whilst I had quite a lot of cash to support the various different businesses that I invest in, it was petrifying. You know, you were on the phone till, you know, 2, 3 a.m, getting up at 6. You know, with some of the biggest businesses in the Northwest, where they were worried they couldn't survive more than 8 to 12 weeks. And, you know, and that was if business went to zero. And it was petrifying. And, you know, you think you're really safe and you've got a decent amount of money. And I think COVID just wiped all the normal rules away. And I don't think you can really blame people for what happened in the different sectors because of COVID, because nobody could have actually predicted it was going to come, really. And the first thing we did was we advised all the companies that we formally or informally advise to draw down their bank facilities in full and just max out their overdrafts and any form of cash they could get their hands on, really, and encourage them to you know, delay paying certain creditors when they could. Because if you have cash, you can survive. It's not about profits. When COVID hit, it was about cash survival. You know, I've never worked as hard in my life as at that moment in time, all unpaid, because you were just helping people survive, really. You know, we had 2 massive deals in Zeus that were about to go, and they were pulled because of COVID, because they were directly affected by what was going on, you know, which cost us sort of 20 million quid of revenue. You know, the furlough scheme and everything else came in, and sort of you realise that, you know, with CBILS and stuff like that, that businesses could get through. And so you then, you know, went from, you know, panic pretty much to, you know, some people would call it disaster planning. I call it panic, because nobody had a clue, really. You know, and I was on phone calls with some of the biggest companies in the UK, and none of us knew what was going to happen, really. And, you know, to then actually, okay, this has happened, what do we need to do? And, you know, one of the things we did was, I think we had one client that was distressed. So for the first 6-9 months of this year, you know, it was tough for Zeus because we don't have an old economy list of clients. They all were doing well despite COVID. And so a lot of that was really about, you know, raising money for them to take advantage of the opportunities that were going to come. And we raised 200 million for Boohoo. We only really had SafeStyle that needed to do a rescue fundraise because of what happened from memory. So the first 6 to 9 months were really tough as a business, as Zeus, because we didn't have enough distressed clients. The client list was too good to actually make a lot of money out of COVID from a Zeus perspective. Obviously, since then, it's completely turned around, and the business is doing very well again. It's probably got its best pipeline it's ever had as a business in terms of opportunities. But, you know, there is, you know, if any businessman says they weren't scared by COVID, they were lying. You know, it was petrifying. And, you know, some of those phone calls, you know, we just didn't know what to do. because no matter what you say, if any business's revenue goes to zero, or you're worried about banking support being pulled, you've got no equity value. So, the start was pretty petrifying, but, we got through it, and, we gave some people some great advice, and the government provided its funding, and then it became an opportunity. But at the start, it was pretty awful, to be honest.
And it's interesting you mentioned Boohoo there, because that sort of leads into my next question regarding, do you think that actually the pandemic highlighted that there were certain business models and certain parts of the economy that were precariously placed anyway? So clearly in March and April it came, and as you say, doesn't matter what sort of business you were shutting down, but there were certainly lots of businesses and lots of high street retail who were simply not robust enough to deal with that sort of shock.
I think it's difficult to criticize anyone, because what happened was so unprecedented. I don't think any business could have had the cash resources or been prepared for it really in what you're referring to as declining sectors. So I think that certain retail chains that failed, it was just inevitable. Their cost base is too high. They have to get the stock in predominantly from the Far East. They have to get it through the distribution center and get it out to the stores. That's a big cash cost really. And that takes time, and you can't react to fashion and trends. And so those business models were fundamentally flawed anyway. It was just a question, they probably would have limped on for another 3 years, whereas they haven't because of COVID. So I think there's been a lot of, there's been sort of 3 years growth in 1 year really. But even the e-commerce businesses were not without their challenges. The unions were very keen on stopping the distribution centres from supplying goods. That would have been pretty damaging to those businesses if that had happened. And obviously, you had to be very nimble, because you had to have, sweatpants and pajamas really, more than going out dresses. So you had to pivot the businesses very quickly to provide a product that people wanted to buy at a price. But I think ultimately, for businesses are for businesses. I think there'll be a lot of lessons that we've learned from this. There's going to be more remote working away from the office. Businesses are going to need less office space. So rents are going to have to go down, and some of that office space will be converted into resi. You actually need less people. In reality, COVID has taught us that you need less people. There's going to be less traveling than we had before. Ultimately that means you'll need less car parks. So there's going to be a lot of knock-on effects. You can see it around the major cities now. Anything in the green belt has gone up in value. There's a shortage of good quality properties because people now want space if they're working more from home. And so people, I think, will travel more, but will go into the office less. Even though I think, the sooner offices open, the better to get, the banter, the camaraderie, the bouncing ideas off each other are really, really important. But I think, people will work from home more. But ultimately, if you've got a weak business and, the market shifts, you just accelerate that decline. I think there's a lot of businesses with government support that ultimately will fail after we get out the other side of this, because there's something wrong with their business model. But as you said before, I think Jeremy said, hospitality, travel, what chance do you have?
No.
Zero.
And on the government support, so obviously there's the unwind and the impact that's going to have once that starts to come down. But there clearly needs to be something to pay for everything, to pay for the rebuild and to get us into a position much better than we perhaps were in February. What sort of stimulus do you think the government can continue to do? I mean, what are your views on just building that debt up? Are you a debt good, debt bad person? And then secondly, what would you like to see from Rishi in the budget coming up?
I think that we as a country we've got about half the debt of Japan, right? So I still think there's significant headroom. if we need to borrow more money with interest rates where they are at the moment. I think that what the government did, was helped a lot of businesses survive the working cap hit of COVID, with furlough and with the various different CLIBILs and CBILs and all the different loans. But ultimately, that money at some point will either be written off or paid back. I think that, ultimately, I would hate to see the government put up taxation, because I think that would be the wrong thing to do at this point in time. I think you've got to get entrepreneurs to invest in the future. There is more risk now than there was. And if the tax rate goes up too high, why bother? You don't need to invest. You can just stay as you are quite nicely, quite frankly. So I don't think now's the time to put taxation up. I think, businesses are going to need to raise a lot of equity to either refinance to get rid of the government debt or to have finance to grow. But, interest rates are low. I'd like to see them invest a lot of money in infrastructure, broadband in particular, road, rail, property if it's appropriate, but we've got to be realistic. Rents are going to tumble in city centres, both for retail and for offices. They could halve. Ultimately, that means rates are going to come down, which means that the local councils and government have less revenue. And, we're heading towards an electric vehicle. And ultimately, the government makes a shed load of money from petrol and from duty on diesel. So they're going to have to fill that hole somehow. I just think that, the time to fill the hole is when the economy is booming, not when it's on its backside, really. And so I think I would hate to see him raise taxation, because I think it will be the wrong thing to do at this point in the cycle. But I think we all accept that's inevitable. But I think that, he's definitely got a hole in his bucket, and I've no idea how he's going to fill it. That's for people far more intellectual than me, to be honest, Anthony.
On the subject of financing for companies, then you mentioned that there's going to be a significant shift towards equity financing. On an earlier panel, there was a lot of talk around the sheer amount of private money that's out there, and I know that you're a firm fan of public markets and the benefit they can bring. And it feels like there's a consensus that the IPO market is going to have a strong year this year. How do those two? One, how did the balance of a firm choosing private markets to an IPO, and then secondly, how, if there is this sudden rush towards the IPO market, how is that going to be? How's that appetite going to be controlled in terms of investor demand?
Well, I think, we've had an awful time in public markets, really. Brexit and the period of uncertainty, and I forget how many elections, 3 or 4. And then you get Brexit resolved to an extent, and then you go straight into COVID. And so, the UK was not an attractive place to invest for international investors. And so, most funds are underweight in the UK. And you're seeing that shifting. You're seeing a mass wall of money come into the UK now as investors look to reposition their portfolio, because the UK stock market is fundamentally cheap compared with world stock markets. So you've got a definite wall of money. I said that at the start that my equity portfolio was down 50%. It's probably up 75% since then. So if you're in public markets, you've had a great ride and you'll put more money in, because most private investors invest on momentum rather than fundamentals. So I think we're entering probably the best IPO market of my career. I think the investor demand is exponential. I think the caliber of companies that are coming to market are exceptional, because there's been a period where companies have ignored public markets and gone the private equity route. I think, again, there's a wall of money in private equity, and they are, a great place to tap money if you want to grow a business privately away from public markets. But I think ultimately all that does is push prices up. I think you'll see, great valuations from the private equity guys. I think you'll see great valuations from public markets. I think it all depends on what the individual who owns the business wants to achieve. If you look at all the great wealth of the world, really, if you go back, it was all about property, then it was about retail and so on. Now it's really about people who have IPO'd their business and stayed on the bus. You know, if you've got a business growing at 30% per annum and you stay on the bus, you're compounding your wealth by 30% per annum. You know, that is difficult with private equity, because you go into a world where the private equity needs a return every X years. Whereas in public markets, you know, when you outperform, you get tomorrow's value today. And, you know, the 200 million we raised for Boohoo, we did in a day. And that gave it a substantial war chest of close to 500 million of cash going into the downturn. You know, and that was, you know, absolutely the right thing to do. So, you know, I think that if you've got a buy and build consolidation story, I think public markets are a great place to be, and the same with tech businesses. And so, you know, my personal view is that, you know, this is probably the best IPO market of my career. I think it will last more than a year. I think it will last quite a long time now, because for the first time, you haven't got significant uncertainty over the UK. You know, Brexit's been resolved. Whether it was the right things to do or not is irrelevant. You know, we are vaccinating ahead of our European competitors at the moment, which should mean that we can return to normal before other economies. And that will be a new normal. I don't think many people will be going abroad on holiday personally this year. I think the politicians will be afraid to let people in and release us in case other variants come in, which the vaccine isn't effective on, but that's a personal view. So I think that, you know, I think I just think, you know, as a corporate financier or an investor, you know, the next 12 months are going to be exceptional, you know, with exceptional returns, really. And it's going to be a great time to be in business and a great time to do deals. You know, whereas, you know, the last couple of years from a public market side has been pretty barren, unless you had a pretty crap client list that needed to raise a lot of money because they were in trouble. But I think, you know, there'll be unprecedented opportunities coming out of the government's financings. You know, they really will, because those companies are, you know, you need to raise equity.
Okay, and I know we've only got a couple of minutes left here, but in terms of where you see those opportunities, then do you have any particular sort of space sectors or, you know, subgenres of technology? Because I know you're a fan in there.
Yeah, I think, look, any software business, obviously, you know, any business that's done well through COVID, you know, should have a premium really with investors, because because COVID ain't going to go away. It's going to be here forever. You know, it's going to replace the flu to an extent. And it's just about what the variants do, whether we have a lockdowns. But I think we'll certainly have restrictions going into winter. And I think not to think that is naive. So I think, you know, businesses that are software related, SaaS related, e-commerce, e-gaming, you know, are all going to do really, really well. You know, and you know, why wouldn't you invest your money in those type of businesses, really? By the same account, I think, you know, there are some stunning manufacturing businesses that have ridden through COVID quite well and are a great place to invest as well. And as you know, Anthony, every deal is different. You know, financial services has always been a great place to invest. And I think that will continue to be the case. But I think you know, we're through the worst without a doubt. I think we will return to a new normal. What that means and how quickly, I just think the government will be incredibly cautious, because they won't want another full lockdown. So I think they're going to let us out in stages. And you know, that's not a bad thing, because, you know, when people get let out, they will go crazy. You know, everyone always keeps saying to me that retail is going to boom when the COVID restrictions are lifted. You know, if you're a fashion retailer, you've got completely wrong stock in the stores. You know, you've got your winter season when you may need your summer season. So, you know, with these businesses, it's not as easy as people think to reopen them. It really isn't. You know, you're going to need to get credit off suppliers. That's going to be really tough. You know, and, you know, I think that's when our insolvency friends are going to be incredibly busy restructuring a lot of these businesses on the other side of COVID, really.
I think final question for me, when we caught up earlier this week, just over chat, you mentioned something that really stuck out, which was that you'd thought that perhaps in 20 years, there would be a situation where the government would be paying people not to work.
Yep.
Which is effectively, you know, almost the furlough system. And just taking what's been said today, so a real focus on tech being the sector that's growing and not a lot of focus on non-tech sort of things. I think you're the first person who's mentioned manufacturing, but you can see that direction of travel. How do you think that plays out going forward from here then?
I think, look, I never, look, I you know, I said the other day, I thought that we pay people not to work in 20 years because of artificial intelligence, you know, driverless cars, drones, whatever, right? You know, just general tech having an impact on people's lives. And, you know, I thought it would definitely happen. And that would be really, really difficult because, you know, having a job gives people a sense of purpose and a sense of pride. And if you don't have that, it's not a great, you know, thing really, or a great personal place to be. You know, with furlough, you know, we'll have had people who have been paid 18 months not to work. You know, that becomes the new norm. So I think there will be a boom. You know, there's a huge amount of cash. You know, a lot of people have got a lot more cash than they had before COVID. You know, they haven't had to pay for a coffee, they're not had to pay for travel, they're not been able to go out, they're not been able to go on holiday, you know, which is why there's a 12, 16-week delivery time on sofas at the moment, because people have been spending it on the house. But there is a wall of money that will be spent when we return to what will be a new normal. And I just hope that we can find a place in the various different businesses to give all those people on furlough a job, so we avoid social anarchy, which is what the government support avoided, you know, where we'd have had people rioting if we hadn't have brought those schemes in. And it was inspired what the government did, really. But, you know, the UK is a huge economy. You know, we really do punch above our weight. You know, not to get the City a deal in the Brexit negotiations was naive, given the amount of contribution the UK financial sector makes to the economy. You know, and that is still a threat over the next 10 to 20 years because we need that money in the UK. But ultimately, you know, we've got to embrace technology here, you know, whether it's cybersecurity, whether it's software, whether it's driverless cars, whatever. You know, certainly the healthcare sector has had a massive boost because of COVID. And I think that the wall of money going into that will continue. But, you know, we are at risk with the USA. You know, the valuations in the USA on either healthcare or tech companies is so far ahead of the UK. And that means they can buy our best companies and they can value companies at levels that we just wouldn't dream at in the UK. And that's because people have made so much money. They take a view on value if they believe they're investing in the right opportunity. And somehow, you know, we have got to create the same in the UK. You know, there are not that many £5 billion tech businesses in the UK. You know, in the States, there's loads at $1 trillion. So, you know, we have to find a way to keep those tech companies funded in the UK. And if we do that and everyone makes money on the journey, they'll take more risk investing in other tech companies and the whole thing becomes self-fulfilling. And, you know, that I think is the biggest challenge for the government. I really do. Okay, well, that's brilliant, Richard. In Q&A, in terms of questions, we don't have any. So I did have one. One did come in from Adrian Altim, but he seems to have deleted it. So heaven knows what that was.
I didn't delete it. So if you're happy to be ask it, that's fine. It's still there.
Oh yeah. Sorry, it was in there, and I've just got an empty chat box. So I don't know what's happened there, Adrian. But please.
That's fine. Hi, Richard. My question was, you know, firstly, how have you maintained your commitment and drive over all these years? Now you're an elder statesman of Manchester Corporate Finance. And the other thing was just, I think you've described a lot of it, was the sort of experience from prior shocks that have helped you in the COVID crisis. But there you go. Agreed, really. I mean, you know, and what do you do? You know, I want to make money. And I think, you know, when you meet truly impressive individuals who've built great businesses and they listen to what you have to say, it's the greatest drug in the world, really. And it gives you a kick. And, you know, we've got 2 businesses that we're working with at the moment that will probably IPO first, second quarter this year. And, you know, I know one of them, well, both of them will be FTSE companies. There's no doubt. They're brilliant. One will be worth 10 billion and one will be worth 5. And, you know, we're helping position those and strategically, you know, point them in the right direction. And there is nothing more rewarding than that.
And, you know, I just love the job. You know, I love business and I love meeting companies. And, you know, I don't want to be the person who's walking behind his wife with a shopping trolley in Sainsbury's. You know, I really don't want to do that. You know, I want to actually go to work and add value and enjoy my life. You know, I don't want to become the guy who talks about what I used to do rather than what he's doing now. And with medical science, you know, I think you can live a long time now. And so I think it's all about, you know, staying fit and healthy and keeping your brain churning over, really. And but I think, you know, in answer to your question on COVID, I think COVID's way worse than all the other crashes. You know, I really do. I think I think 87, you know, I was a young kid then, and a lot of people lost their houses, and it was pretty horrendous. But they just, you know, and there wasn't the government support that. We haven't printed money like we have in COVID. I think, you know, the government have got us through the worst by printing money. How that unwinds, I just think we'll end up having a larger amount of debt for a longer period of time, and interest rates will stay low. And the fact that the whole Western world's done it means that the currency's not devalued. I just think it becomes the new norm, actually. And I think we'll keep printing money until we get people back to work and through the other side of this to avoid social anarchy. But ultimately, you know, anyone who's, you know, if you love your job, you can be really good at it because you want to go to work. You know, I certainly didn't enjoy the 20 hours a day I was working at the start of COVID. You know, it's down to sort of 14 now, and it's much more enjoyable, which is much more balanced. But yeah, I love my job. You know that, Adrian, I love my job. And if you love your job, it's easy to be good at it.
I agree. Thank you.
Okay, thanks, Adrian. Do we have any more people who may have asked the question and disappeared? No, I don't think so. So just to thank Richard for your time. It's always a pleasure to hear from you. You've always got some fantastically bullish and insightful thoughts to share. So thanks again.
No, pleasure. And good luck everyone this year. It should be quite interesting.
Well, I heard the word exceptional, so I'm going to hang on to that, Richard, if that's okay. And hopefully you can join us next year and you can prove us all right. You can prove it right.
I think if you've got the wall of money, ultimately means things go well. You know, we have a wall of money, you know, whether it's in private equity or whether it's in the stock market, there is a wall of money chasing the right deals. And, you know, we will return to a new normal, but we're going to, you know, everyone's going to be vaccinated every year for a long, long time. The worry is the variants of COVID that we don't know about and what that means to the vaccine, really. And, you know, but look, it's dead simple. If you don't want COVID, you need to lose weight, you need to watch what you eat, and you need to be relatively fit. And that's the key to COVID. You know, you've got to be slim. You know, you've got to watch your diet. You know, you really have to be careful of certain types of oils you put in your diet. And if you're relatively fit, you can survive it. And I'm amazed the government hasn't really rammed that message home to people, because this is all about lifestyle. And if you know, I had COVID and I was in bed, I had a CT value of 16, which is really high. And I took my resting heart rate went from 45 to 110 overnight. But apart from that, I was fine because of my diet and because of my fitness and all the rest of it. And I think, you know, that should be the next message the government starts giving to people, is that, you know, okay, you've got a vaccine, but please, you know, get fitter and change your diet. Because if you do, you know, you won't put as much burden on the NHS if you get ill.
I mean, I'm a big advocate for exercise and staying fit, but I think the other important point on that is to do with the mental health as well, actually. So, you know, I think it's really important to get out there and get your daily dose of daily dose of exercise. I was out there this morning with the sunrise, and it was absolutely beautiful. Cold, but beautiful. Thank you, Richard. Really do appreciate it, and thank you to Anthony for hosting that conversation and for the previous panel as well. I'm going to wrap up today because we have overrun slightly, but it's been really great. Thank you to everybody who took part, to all of our panelists, all of our speakers. I think there has been a real theme of positivity there. I'm going to use Richard's word of exceptional year ahead. to come, which is really, really great. And let's hope that does come to fruition for us all. My huge thanks as well to our sponsors for today's lunch, which is the International Stock Exchange. Thank you to them for making today possible. And a huge thank you to all of you for attending. I hope you have a wonderful afternoon and a great weekend.